What is the effect of psychology on trading? Explore the ways in which various psychological factors, such as personality, emotions, biases, and social pressures, can shape financial decisions. The impact of emotions and moods on trading. Emotions are physiological responses to events that occur in the moment, while moods are longer-lasting effects of emotions. The emotional state of a trader can greatly impact how they respond to various triggers and circumstances. This video delves into the psychological aspects of fear, greed, hope, frustration, and boredom, and the effect they can have on a trader's performance. What does fear mean in the context of trading? Fear in trading refers to the anxiety or distress caused by the potential for loss, whether real or perceived. While fear can help to curb impulsive behavior, it can also hinder decision-making, leading a trader to exit a position prematurely or miss out on a profit due to an excess of caution. Research by Lee and Andrade found that inducing fear in a group of traders by showing them horror movies resulted in 55% wanting to hold onto their positions, while the control group, in which fear was not induced, saw 75% of traders still holding onto their positions. Another study showed that less experienced traders were more impacted by fear and uncertainty compared to professional traders. This might be because professional traders have likely experienced more losses and are thus more comfortable with the risk of loss in order to secure a profit, or because they have more discipline, recognizing the benefits of closing a losing trade rather than letting it run. How can traders mitigate the impact of fear on their decisions? There are several ways traders can limit the influence of fear on their actions. One approach is to have a plan in place for each trade, and to use stops to minimize losses and limits to lock in profits. By thoroughly researching the trade through technical and fundamental analysis and correctly placing stops and limits, traders can feel more confident in their ability to avoid unnecessary losses. Technical analysis, such as using supply and demand to identify levels of support and resistance, can also be useful in determining appropriate levels for stops and limits. Greed. Greed in trading refers to the tendency to make impulsive and irrational decisions in an attempt to maximize profits, often at the expense of sound risk management. This can involve taking on too many positions or holding onto positions for too long, even if it carries a high risk of incurring significant losses or wiping out previously earned profits. It is characterized by an excessive desire for financial gain, leading traders to act in ways that may not be grounded in reason or caution. Greed can influence a trader's decision to trade more frequently. A study by Graham Harvey and Huan found that an increase in a trader's confidence can lead to an increase in their trading frequency. How can traders prevent greed? To prevent greed from influencing their trades, traders can employ risk management strategies. These strategies help traders understand the risks of using leverage in trading and the importance of not taking on too much risk. By familiarizing themselves with these strategies, traders can better manage the potential impact of greed on their positions. One method of managing risk is to use a risk-to-reward ratio, which compares the potential loss to the potential gain for each trade. For example, if a trader places a £300 trade with the potential to realize a £600 profit, the risk-to-reward ratio would be 1 to 2, as the trader stands to gain twice as much as they stand to lose if their predictions are correct. This ratio can help traders make informed decisions about the level of risk they are willing to take on in each trade. The hope. What does hope mean in trading? Trading hope is an emotion characterized by an expectation or sense of optimism, confidence, or experience. It is essential for all traders to possess some level of hope when entering trades. However, having too much optimism can have negative consequences. For instance, a trader might persist in keeping a losing trade open with the expectation that it will eventually change direction and yield a profit. A research conducted by Nossinger has shown that traders struggle to sell losing positions due to the perception that it represents a personal failure. Traders have the expectation that the value of the asset will improve, so they can avoid confronting the possibility that their decision to open the position was incorrect. The level of hope an individual possesses can also affect the frequency and degree of risk of their trades. How can traders prevent hope from impacting their decisions? A strategy to avoid allowing hope to influence your choices is to establish a set of objectives and record them in a trading journal or diary for your time in the market. By defining objectives, you will have a clear understanding of what you are hoping to achieve from your trading, and thus be less prone to prolonging losses due to disappointment. Additionally, having a set of objectives can help to manage your expectations, and as a result, you will be more content with what you have achieved. This approach can help to prevent greed from taking control and discourage you from opening new trades with the aim of making more money. Boredom. What does boredom mean in trading? Trading boredom is the feeling of being wary of the financial markets and perceiving one's activities as tedious, resulting from a trader feeling that their routine has become dull and uninteresting. This situation can lead a trader to divert from their strategy and engage in unnecessary risks in the hope of introducing some thrill in the trade. Boredom might occur if markets are moving gradually or if a trader's returns are not as substantial as they had hoped for. As a consequence, a trader may indulge in sensation-seeking behaviors as a way of coping with boredom, seeking out new, diverse, intricate and strong experiences and emotions. However, this can lead to excessive risk-taking. How can traders prevent boredom? To avoid the effects of boredom, one can use a simulated trading account to experiment and refine new strategies in a safe environment without incurring any financial risk. This approach can be advantageous if you are tired of your current trading approaches and interested in exploring something new. By using a simulated trading account, you can engage in trading without the risk of losing your own funds. Traders can still experience excitement while trading on a simulated account, and it may also help them improve their skills and increase the chances of success on the actual markets. Frustration. What does frustration mean in trading? Frustration in trading refers to the feeling of annoyance or disappointment that traders may experience when the markets do not behave as they had expected. This can be caused by losses or by not realizing as much profit as anticipated. Traders may become frustrated when the markets behave in a way that they did not anticipate, leading to feelings of disappointment or irritation. The timing of a loss or series of losses can significantly influence a trader's level of frustration. According to research, traders who incur losses in the morning are more likely to take on above-average risk in the afternoon, compared to traders who experience gains in the morning. This suggests that the time of day at which a trader incurs a loss can impact their level of frustration and potentially affect their decision-making. One way for traders to avoid feeling frustrated is to accept that it is normal to experience losses when trading. This video made possible by HankoTrade. Trade with a true ECN broker. HankoTrade is offering a diverse range of trading instruments and services to ensure your financial freedom. Check link in the description to profit 100% deposit bonus. We hope you enjoyed watching this video as much as we enjoyed making it. It took us several working hours to put it all together, but we're happy to have shared it with you. We're particularly excited because this video represents a new style of content for us that we hope you enjoyed. Thank you once again, and we'll see you next time. Stay awesome, and remember to like, comment, and subscribe.